Hello, everyone. On December 19, 2018, the Federal Reserve raised the federal funds rate by 0.25% to now be in a range of 2.25 to 2.5%. Now, the federal funds rate is the rate at which banks lend reserve balances to other banks on an overnight basis. And the federal funds rate is important because this rate is tied to most consumer debt, particularly credit cards and also adjustable rate loans. Now, the Federal Open Market Committee, abbreviations FOMC, they meet 8 times a year to determine this federal funds rate. And it just so happened today they actually did raise the rate. Now, today was actually a very volatile day in the whole U.S. stock market. I want to show you in this chart here, the S&P 500 started to crash at 2 p.m. Eastern Time, and this was the time when the news of the hike occurred. The S&P is now down about 13% since the peak in early October 2018, and it is now down about 5% year to date. It is important to have context as well. So I actually want to show you this longer time frame of the S&P 500. It looks very healthy long term. Almost seems like the U.S. market can actually go higher over time. And one thing I just want to remind investors is that the economy, they move in cycles. And what I mean by that is that the cycle can go up, but the cycle can also go down. And I want to put some numbers out there to just kind of put everything into perspective here. This is the second longest economic expansion ever. This second longest economic expansion is lasting at 113 months. And the record, in case you're curious, is actually 120 months of economic expansion. And this occurred in the 2000s where it peaked. Now, if we do continue on until July, this economic expansion will be the longest ever. So just keep that in mind. Now, I want to dig a little bit more into the federal funds rate. It is all relative, but really, please keep in mind that we are coming off an extremely low and abnormal 0% Fed funds rate that occurred from 2008 to 2015, where the U.S. economy was still kind of getting back on its feet. Interest rates have gone up 7 times since Donald Trump took office. 4 of those increases have occurred under Chairman Jay Powell. Now, think of the economy as a little kid needing training wheels on their bikes, right? Over time, the kid will grow and they'll get better at biking, and they'll simply remove those training wheels as they mature, right? Well, the economy has been maturing, and it is time to take off those training wheels. You want to become a grown man or woman, like this guy here. Now let's take a look at some primary source, right? Directly from the Fed themselves on why, these training wheels for the economy is now coming off. The Federal Reserve says that the labor market has continued to strengthen. And that economic activity has been rising at a very strong rate. And that's very true. Unemployment remains very low. As well, household spending has continued to grow. Right? The Federal Reserve really has 2 mandates. Number 1 is to make sure we have low unemployment. And then number 2, actually keep inflation in check. So the Fed is fulfilling their mandate. Therefore, in my opinion, it doesn't seem like it makes any sense for Donald Trump to criticize the Fed for hiking. The Fed is simply doing its job. When when Jay Powell was asked earlier today about the pressure that he's getting from the White House, Jay Powell responded in a very interesting way. He said that we're going to do our jobs the way we've always done them. The Federal Reserve is trying to stress that they are independent and they're not caving into political pressure. Specifically, Jay Powell says nothing will cause us to deviate from what they've always done. Now, going back to this S&P 500 chart, we actually took a much larger dip later in the day, and really there's a few reasons that I can think of that I want to share with you, and it's important to keep in mind. Number one, the Fed officials, they actually marked down their growth forecast for this year, 2018, as well as 2019. The Fed officials are predicting that the growth forecast GDP for 2018 will be 3% exactly. For 2019, GDP will be at 2.3%. Secondly, another reason why the market just tanked later in the day is that really when you look at the market, the Fed really cautions that people should not just look at the market, but also think about the macro data, because the market is not just a single dominant indicator for anything. So this actually leads investors to believe that the Fed will become more data dependent as opposed to relying on market sentiment. Even though some people will actually note that the Federal Reserve are only calling for 2 rate hikes in 2019, a downgrade from 3 hikes, which actually is a good thing. However, it is important to keep in mind that Powell, he simply does not see the Fed changing its strategy in terms of shrinking its balance sheet, and this is the main reason for the later dip in the day. And I'll talk about this in much more details in another video. But essentially, the Federal Reserve is allowing $50 billion a month to roll off their balance sheet. This is $50 billion in bonds maturing. And, the Federal Reserve accumulated all of these bonds during the 2008 financial crisis. The Federal Reserve, they were buying up government bonds as well as mortgage-backed securities to help add liquidity in the economy. However, now that the economy is much stronger, the Federal Reserve, they're simply letting $50 billion of bonds just mature, and they're no longer reinvesting the principal that they get back from the bonds into buying more bonds. So, I'll talk about this a little bit more in another video, but really, again, today's video is just to show you how tricky of a situation the Federal Reserve is in, right? Number one, we have a very strong economy based on economic data. The Fed has to hike. However, as the Fed keeps hiking and reducing their balance sheet through quantitative tightening, that's getting harder on corporations, the average consumers, because they're paying more to borrow money. In addition, liquidity is being pulled out of the U.S. market as well, and this is just something to really be alert on, because this could actually have a very large negative effect on the U.S. market as we enter 2019. Personally, I believe 2019 is going to be a much worse year, simply because the economy is slowing down. Corporate profits should slow down. I don't believe in what big institutions are saying about how companies look cheap right now. I don't agree with that. When you actually look into the numbers and start marking down the data, companies don't look cheap. And 2019 is going to be a hell of a ride. So, my personal take is, if you're going to be bullish on something, be bullish on cash and also be bullish on buying puts. So there you guys have it. Thanks for watching this video. I look forward to making more of these videos. I enjoy making them. So let's keep learning from each other. Feel free to drop a like if you found this video helpful. Feel free to subscribe as well. If you add a comment, I'll reply back and I'll share my thoughts as well. So until next time, hope you sleep well in your stock positions. Hopefully you sleep well with your cash position as well. So thank you again for watching. Until next time. Bye.